Welcome to the Micromobility Podcast. I'm Prabin Joel Jones, your host. Today, I have somebody that just acquired another big business. So M&A is happening across the world in micromobility. We had smaller companies acquiring big companies. For example, Dot acquired Tier. And this is also kind of a similar story. So it's a company based in Dublin called Zeus Scooters. And they just acquired all the assets of Superpedestrian. And I have Damian Young, the founder CEO of Zeus Scooters, with me. I know him for quite some time, and the funny thing is that every time I talk to him, he's doing something different. I've met a lot of young chaps in this industry who are building businesses, but I think Damian is one of the most energetic people that I've met in this industry. So
And
super
probably one of the
excited
oldest.
to. So super excited to have Damia on the pod today. Welcome to the pod, Damia.
Thanks a million. Thank you, Pravin. Great to be here.
Perfect. So for people who don't know you, I mean, I try to make a quick intro, but then, for people who don't know you, can you make a quick intro about you and the company?
Yeah, well, first, I suppose I'm Irish, so excuse my accent, but many people do like the Irish accent. So Damian Young is my name, and I am the founder, CEO of Zeus. And as Pravin just alluded to, I do have a lot of energy, and I'm probably one of the older founders in micromobility in Europe. But I suppose my career, Pravin, has been very different. My career was a career banker, actually. I grew up in banking. I was an executive with one of the main banks in Ireland. And I worked through the kind of international division and the business banking division and the liquidity management area of the bank for about 25 years. And in kind of 2014, I decided to join an early stage company involved in data and analytics. It fascinated me. They were using data to support banking as well with pricing. So pricing has been a kind of a key part of my background as well. So I spent about 5 years with them. I was based across UK, Europe, and then into Australia, New Zealand, where I spent about 5 years. And when I came back to Ireland, I decided I wanted to, look at a venture myself. And this is how Zeus was born in kind of late 2019. I formed it at my kitchen table.
What a time to start, right before COVID.
Well, I didn't know that at that time. If I had known, I would have gone into the business of surgical masks, I think, at the time. So
yeah, that was a good business then.
Yeah.
But tell me the founding story of Zeus. What was the idea? Did you see a unique market? Was it like specifically Ireland as a market, or did you see the global market as an opportunity? What is the opportunity that you were going after?
Yeah, so I suppose in 2019, when I came back to Ireland, I spent a little bit of time in mainland Europe, and this was the first time I saw shared e-scooters. And I'll be honest, I didn't know exactly what they were, why they were sitting on the streets, and so on. Did a bit of research, used them, and I thought this is phenomenal, right? Getting around a city, from a cultural perspective, using this for very cheap is a fantastic way. And I thought, this is something that we need in Dublin, in Ireland, because we've a significant tourist industry. There's a lot of heritage and culture background. We get a lot of visitors from Europe, from the US, from our neighbours in the UK. But transport and mobility, I suppose, is pretty poor in Dublin. So when I started kind of researching the market and so on, Ireland was first and foremost to my mind. And at the time, then I decided to meet the then Minister of Finance, a guy called Shane Ross, whom I knew from the past, and he was the Minister of Transport. And talked to him about this. And what he told me at that time in 2019 is, yes, legislation is imminent for this. And we eventually saw legislation come in Ireland in 2024. So just only 5 years later. So, back in 2019, when I saw that this really wasn't going to move fast through the legislative process, I thought, well, either we abandon the plans or we look for a new market. And that new market was Germany. And that was our first market. And I suppose, Robin, we kind of, I looked at this, from an incumbent perspective in the sense that, who are the big players, the usual suspects in Europe, and what are they doing and who are their riders and so on. And what I noticed was, that first of all, the rider profile was predominantly male,
Yeah.
predominantly the ages between 18, 26. And I've just slightly gone beyond 26 myself. So, I thought, well, where's the market for, maybe the over 30s and the over 40s and even the over 50s, and female users. And this is what brought us to the design of a three-wheel scooter, is really to kind of focus on a very different demographic. And then the other thing that we focused on then was not to necessarily target the very, very large urban areas, because, that's where these incumbents were. That's where they were building kind of mass footprint. And we just felt, well, we can't really compete against that, not our size. But there's a big gap in the market in smaller locations. So that was the kind of the thesis behind the thinking, and from there, then we went, full speed ahead to design the scooter, to get it tested, to launch our first fleet, and we have been focused on growth through every avenue since then.
God, there's so much to unpack, but let's take it one step at a time. So, what's very interesting is the three-wheel scooters, right?
Yeah.
I don't think there's a lot of companies that experimented with it. I can maybe think of two or three. There's also a company in Australia, I believe, called Ario, that actually, designed their own three-wheel scooters. At some point, Segway came up with a three-wheel scooter as well, with auto parking technology and all that stuff, but it didn't really pick up momentum, the three-wheel scooters, right? But from I think you're probably one of the only ones, maybe, deploying three-wheel scooters at this scale, right? You told me that the initial thesis was that that there's a certain set of users that probably will use it, of a certain age. Was that true after deploying, or how was the distribution after deploying?
Yeah, I mean, first of all, I mean, just to pick up on the point there, the three-wheel scooter, I mean, we still are virtually the only kind of brand on a slightly bigger scale that operates three-wheel scooters. We did test other scooters at the time, and in reality, the design of them wasn't as stable as what you would expect, and the one that we designed was extremely stable. So more kind of stable. You mentioned Ario there. I mean, Ario very much focused on self-driving and tech, and in my view, and this is only my view, it's lipstick on the pig, right? It's not something that can work in this industry, right? And the cost of an individual device like that scooter is significant, and therefore the unit economics won't work, right? So when we designed it, we needed to design it for safety, stability, smoothness when we were when using it in locations, but also, as you say, to kind of tap into the more cautious user, right? And that might be gone now in some ways because people are used to scooters. But back in 2019, 2020, these were new, right? And scooters were new. So, there was an awful lot of caution of how do I, balance on this and so on like that. And, obviously ballsy 18 to 26-year-old males didn't have a problem with it, right? But others did, right? And what we found, in terms of our recruitment in the first couple of years was that it was over half of our client base, our customer base was female, right? And
Wow.
a
Okay.
considerable amount over 30, right? I mean, we had one user, a regular user, in his late 70s,
Wow. Okay.
in one of the southern German towns.
Mhm.
So it's fantastic, and that's what we believe, I suppose, the kind of micromobility is there for everyone, should be there for everyone.
Yeah.
So why not do this, right? So I do think it did work, and as I say, now people are kind of used to scooters, and it's not as novel as it was, or people maybe not as cautious as they were, and as a result, I mean, we've brought in designs of two-wheel scooters to complement our fleet. And funny enough, when we were operating in the UK, all of our fleet was two wheels because the
Mhm.
UK government decided to define what a scooter was in their legislation, and that
Mhm.
definition stated they were two wheels. So we couldn't bring a three-wheel scooter.
Wow. Okay. Uh, so, another thing that is very bold move from you is, trying to design a scooter by yourself, with, of course, with the external partner, but then, even trying to design something with an external partner, it's very risky, given the fact that you didn't raise a lot of VC funds, right? Can you tell me the thinking behind it? Did it go well from, how you planned initially? Because it's a very, very bold move.
Yeah, I mean, look, the our partner, that kind of, built the scooter. He is an engineer, and
Mhm.
so therefore, he has spent a lot of time on the design concept. So while we kind of supported the design, particularly on our second iteration, we designed ourselves the second iteration of the scooter, more from a functional perspective.
Mhm.
The design work that he did from the start was very good, right? And this is a smaller company, um, and therefore could give us more time, and we could give them more time.
Yep.
I mean, at the time, I remember reaching out to the usual suspects. I won't name them here in terms of the manufacturers, but I
Yep.
don't even think I got a response, right? So
Mm.
and in my I suppose my kind of thinking as an entrepreneur, as a businessman, and so on, is I like to build kind of partnerships that are enduring, and that we can spend a lifetime a partner. And
Yeah.
everyone knows lifetime value is more profitable. Um, so by not by engaging this, we're continuing to work with him 6 years later.
Mm.
And I think it may have been ballsy, right? A little bit
Yeah.
bold in terms of the move, right? But those original scooters that we got are still in operation, right? So
Mm.
they've been very robust, and we're very happy with them.
So it's like 6 years.
6 years, yeah, yeah,
Wow.
yeah,
Okay. Okay.
yeah.
And
But
then do yeah.
but we
Yeah.
introduced them, and again, this was done with our partners. So we
Mhm.
introduced rejuvenation in 2022.
Mhm.
And what we did, again, wintertime, as all the operators know, not great. You might be better off with smaller fleets and lower costs, and particularly like company like us where we don't have mounds of cash.
Yep.
Um, so we took the time over the winter period there to take 2,000 of the scooters off the streets,
Mhm.
bring them to a warehouse, and every single one of them was stripped down,
Yep.
recomponent, re-decaled, retested, and put back out as obviously like new scooters, right? And I know
Yeah.
the industry is doing that now, but I think we were kind of slightly ahead of the curve because do you know
Mhm.
why? Because we need to. We didn't have the
Yeah.
money to invest in another 2,000 scooters.
Got it. So, in terms of the market focus, so a couple of years ago, when I was thinking about how the market would evolve, one of the thinkings that I had is that the bigger players probably they would capture the biggest markets like London, Paris, Brussels or Berlin, right?
Hmm.
And you have maybe like two or three of those. So, and the remaining tier 2, tier 3 cities would be left out, right? Because it doesn't make any sense for a very large operator to deploy a couple of hundred scooters in a small town, right? But then if you look at these small towns and aggregate them together, and the demand that is in these towns, probably in aggregate, that's much bigger than the big cities put together, right? So it's a massive market, the tier 2, tier 3 cities, right? So I was very excited about smaller companies focusing only on these tier 2, tier 3 cities and not spending their money on mega cities, right? What was, as far as I understand, your focus was exactly that, right? I mean, not going after London, not going after Paris, and all these big ones. Your focus was tier 2, tier 3. Right.
Yeah.
Can you unpack a little about the thinking behind it? Why do you think tier 2, tier 3 cities are like very different from London, Paris? Just generally unpack your thinking behind focusing on tier 2 and tier 3 cities.
Yeah, well, look, I suppose the original focus back in 2019 when we were doing our kind of market plan really was about what the market looked like at the moment at that time. And as you had the likes of Bird, the likes of Lime, Tier was very big were getting very big at the time.
Yeah.
All of them had collectively raised literally in the billions, and we were there. That we were delighted with our seed round of 1 million. So it was we were very different, right? So we thought, we're not going to try to compete head to head with them, right? With their 7,000-8,000 fleets in one location. I said, but also, when we looked at the market, Prabin, these smaller locations, and they're not all that small, right? But the smaller locations tend to have a less developed transport infrastructure. So there's less mainline trains and trams and whatever, and bus connections and so on. And the whole idea of micromobility is being able to get around, right? And in the likes of Berlin's and Paris's and London's, well, you can get around, right? They have their metros, but the smaller locations don't have these, right? So therefore, the kind of connectivity for transport infrastructure in those smaller locations is probably more key, right? So to have micromobility, so if you are, if there aren't trams and you need to get to your final destination, you get the mainline train in, there needs to be an alternative there for them. So what we found was that there is a demand in those locations. I suppose secondly, and I'm not one. I hate bureaucracy, and I hate politics, and I hate all of that, right? And there is less of that in smaller locations, right? There's less of the pompous political, bureaucracy that just weigh you down in terms of trying to make progress, right? And you can tend to create relationships with, the people in the town or the city, the small city, both at the government level and individuals within the location. So therefore, with that kind of cooperation and so on, you tend to have a better working relationship. You tend to get more done. You tend to get more away with more as well. And that's important. That you are kind of working hand in hand, and you deliver. I mean, we ran this program called Give Back, which was when we entered the town, we would kind of allocate a little fund from the revenue that the customers in that town gave for the rides, and then we'd look at local charities in those locations, and then just do an award. It's a small award, like €500 or €1,000, for helping smaller kind of charities and smaller locations. So that kind of built a kind of a community around it as well. So there's a lot of good reasons, right? And I'm very much commercially minded as well, right? And it's important that the unit economics worked and places were commercial. And while some places they're not great, right? They're not good. But as you mentioned, like we operated under kind of a cluster system, right? So that a collection of 3, 4, 5, 6, 7 locations is as big as one location. It just
Yeah.
happens to be 5 or 6 different locations, you know.
Yeah.
And if you go to Berlin, Berlin is massive, right?
Mm.
You know, and how many suburbs have they got of Berlin, right? It's still Berlin, but
Yeah.
it's huge, right? So we have the same principle, right? But
Hmm.
we believe that for us, it's a better market because we are a small player.
Yeah, but how does it differ in terms of utilization or revenue per ride and all that? I mean, generally we know the numbers of the big big players today. We know the number of rides that they do per vehicle. We also know the revenue as well. How does it differ in smaller city, smaller towns? Is it better? Is it the same? Or how does it differ?
It does vary. I mean, we do see
Hmm.
variances. You know, one of the things that we don't really focus on is rides per day per scooter, right? And
But
the
that's a
reason,
key metric for a lot of people,
well,
a
yeah,
lot of companies. Yeah,
and I suppose my challenge with that, you know, is that, you know, it really depends on your overall financial model, right? And a lot of our financial model is based on variable costs, including, and many
mm,
players will know this, including insurance. So
yeah,
insurance is only paid, you know, when the vehicle is moving, right, or when it's being used. So every ride, you are paying a per minute cost of that insurance. Um, so when you do the numbers and you say, well, oh, listen, I want to do 4 rides per day, and you run the 4 rides per day, your costs actually start deteriorating your net revenue.
mm,
Um, and that's why and you know, my background is pricing. So what you have to try to do is you have to find optimization. And therefore, optimization from our perspective, in our view, is not how many rides, because there's
mhm,
vanity and then there's sanity. Vanity is I get 7 rides per day,
mhm.
but I don't make any money. Sanity is I get 1 ride per day, but on that ride I earn €1, right?
Okay.
Net. So that's what
Mhm,
we look at. We look at what we call the financial productivity model,
mhm.
which says it's not about rides, it's not about the number of rides. It's about, you know, the productivity of those rides, and overall productivity then as well,
Okay.
if that makes sense.
Yeah, I mean, I want to understand that a little bit more because we know about revenue per vehicle per day or revenue per trip. These are popular metric that we
Yeah,
compare across
and
operators,
we
right?
gauge all of those. Yeah,
Yeah, yeah, but but what you're saying is that you don't care about having the max number of trips from a
no,
vehicle in a day, but it's about having profitable trips,
correct,
right?
correct.
But the more trips the vehicle does in a day, I mean it's more profitable, right? I mean, or
No,
am I getting
but
that wrong? No, okay,
not necessarily. No,
yeah,
not necessarily. Depends on your cost base, and depends on how
mhm,
the cost base works, right? So
uh-huh,
what you'll find is, you know, because there are certain costs in our model. I mean, I can't talk for other people's models,
yeah,
but in terms of our model, some of the things will skew it and will,
mm,
I suppose, deplete that kind of profitability. You also have
okay,
to remember that, you know, the you know the uh, the wear and tear of a scooter, etc., you know, obviously increases with the number of rides. The
yeah,
number of batteries that you need to swap increases with the number of rides, which means your operational costs go up as well. So it's about a balance more than anything else. I'm not saying that we
yeah,
prefer to, you know, you can't obviously have 0 rides because you're not generating revenue. But, you know, when you look at, and we have a very kind of clear matrix based on the costs, we can see what the kind of optimal number of rides would be in terms of profitability of those rides. But obviously,
yeah,
quantum comes into it then as well, because, you know, you obviously want to increase overall revenue and overall profitability. But you need to, what we do is we need to look at the individual revenue per ride, and what's the optimum rides that we are
mhm.
generating that revenue at.
Got it. Yeah, it was a couple of years ago when Twitter user, I forgot the name, forgot the handle, who actually made this exact calculation to say that, having max number of rides from a vehicle in a day is not the right metric, because at some point it's actually, acts as a negative thing, because
Right.
you're going to lose money after a certain ceiling. Right?
That's exactly it. Yeah.
Yeah.
Was that me?
I
Was
hope.
it?
I hope it's you, but
No,
yeah,
it's just pure kind of, it's mathematics, right?
yeah,
And look, what I used to do in the past in banking was, create pricing models, right? And the
yeah,
whole idea was what we call price optimization. And price
yeah,
optimization is, in banking, it's a little bit different, right? It's a case of, if there's 1,000 savers, with €1 million in their savings account, at what rate does one of those savers attrite? In other words,
yeah,
they're not happy with the rate, but you could be happy with 20% attrition at an
hmm
optimum rate, because your net effect is better than if you had all of those savers at a lower rate, right? And
yeah,
it's basic kind of price optimization. So we've spent a lot of time looking at these. I'm not saying
hmm
that we're perfect, right? I'd
yeah,
like to see more kind of activity and so on, and hence, that's part of our strategy now is how do we grow?
hmm
Because the growth here is what's important, in that we have achieved EBITDA positive levels since 2023,
hmm
but the cash production of that EBITDA is not sufficient for me to go and buy new vehicles.
yeah.
So how do we leverage our model to create more economies of scale so that EBITDA level is sustaining the business?
Okay. So, so if you look at a couple of years ago, right, companies started talking about EBITDA being EBITDA positive, right, and then there was a whole discussion around it. Is EBITDA the right metric for shared micromobility? It's asset heavy. You're not taking depreciation into account. So then EBIT became the term by which companies were measured, right?
Yeah.
And somebody called me a couple of months ago, Mr. EBIT, because I was like, pushing this really hard, saying, EBITDA is probably not the not the right measure. EBIT is the right measure, right? But now, as we stand today, companies are much mature, and we are moving in a direction where more companies are talking about being cash flow positive than just being EBIT positive, right? Where do you stand in that? I mean, do you think EBIT is still the right measure, or
No,
EBITDA is the right measure,
there's
or is
actually
it like
no,
just
yeah,
yeah,
there's no right and wrong, okay? Because
yeah,
at an early stage in this industry, in this business as well, um, you know, when I started this, um, I said, look, by our third year of trading, I want to get into EBITDA positive.
mm,
Um, but that's not where I started. So, it's a case of, well, first of all, how is revenue generated, and what are the unit economics behind revenue? Let's get that right first, right? In
yeah,
understanding that. But then, most importantly, it was gross margin, right? And it was saying,
mm,
well, how do we kind of sustain the level of gross margin? Because we're nowhere near even at the moment. So
yeah,
worry about that some other time, right?
mm,
Get a stable gross margin. And then you then understand your kind of head office costs, for want of a better word.
mm,
So how much activity do you need to fully absorb those head office costs to get to EBITDA positive, right?
yeah,
That's the next step, right? Is EBITDA. Following that, then yes, you're absolutely right. You've got assets, you've got amortization, and you've got depreciation, and so on. And you need to then focus on the next step, which is what I call just net profitability, right?
yeah,
But in the early stages, where a lot of the growth has come from, whether it's venture capital, whether it's venture debt, or whether it's something else, it's not coming from the cash of the business; it's coming from somewhere
mm,
else, right? You then, you'll only get. I mean, the way I look at it is, you'll only get to EBIT positive if you've got EBITDA positive, right? So,
yeah,
so while yes, that is your end result and what you want to strive towards, the most important thing is that your trading entity, because don't forget your assets, their
Yeah.
capital expenses, their balance sheet entries, they aren't impacting your cash flow. So your trading business needs to get to a positive cash flow, EBITDA, to sustain any debt
Yeah.
repayments, and then eventually then all your depreciation as well. So I think
Got
it's a
it.
journey more than anything else. There's no,
Yeah.
there's no right or wrong
Hmm.
answer,
Hmm.
but in our view, it is a kind of a journey that leads up to, you want to have a net profitable business.
Got it. If you look at companies that started in 2019, there are not many companies that are around, right?
No,
Especially companies that, there are companies that raised a lot of money that vanished. There are companies that did not raise a lot of funds. Many of them, are not around, right? But, from the time I knew you, uh, there are times when you were walking on a tightrope, but then you're still here. You're still surviving, right?
that's Monday to Sunday.
Yeah. So what I want to understand is how did you survive these years, because you didn't raise a lot of funds, right? I mean,
No, no,
it's not a massive VC story, but then
no.
you managed to survive so long, right? How did you manage to do this? Because general wisdom is that in this business you need a lot of cash to survive, but then you actually broke that conventional wisdom. So
Yeah, I
how
mean,
did you do
look,
that?
in our journey, we have not raised very much cash, right? We have managed cash very well. We have very, 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 very tight disciplines in terms of cost management and price optimization and unit economics and so on. And we've had that from the word go. And I suppose that's probably part and parcel of my background. I also don't, I mean, I'm not somebody that likes to give up, right? And,
Yeah.
this, and as everyone knows, this is it is a tough business. It's a tough market. Would I go into it again? Possibly not, right? But now that I'm in it,
Yeah.
I want it to be successful for our company, and I want to do the best I can to make it successful, right? So we have, and like when we went into this market back in the day, um, sure there was lots of money around, right? And one of the first things I said at the time, was when I saw how much people were raising,
Mhm.
and on the back of what I then knew what the economics were like and so on, I said, well, we're going to see those large guys go bankrupt,
Mm.
right? And it happened, right?
Yeah.
I knew that. I mean, I've worked with businesses all my life, right? So
Yeah.
it, it, there was going to be bankruptcies, right? And we saw Bird going bankrupt. We saw Superpedestrian going bankrupt. Why? Because I don't know. I actually don't know why. Why? It, I nearly blame the investors, right?
Mhm.
Because the investors going into something and believing the hype of uh, whatever unit economics they were banding around with, but
Yeah.
also the lack of business discipline, cash control, cash management, and so on, at a large scale. Because when it gets to a large scale like that, it can turn extremely quickly, right?
Yeah.
So we set ourselves up to try to go bottom up, right, rather than try to go and raise 50 million from the start. It was a bottom up approach, which was, let's build up the business, let's prove out the unit economics, and hopefully then we can bring in the bigger cash to get the scale. Now,
Yeah.
unfortunately, that kind of coincided with everything else went tits up.
Yeah.
And a lot of people a lot of companies were in trouble, and therefore investors were just not interested in this sector, right?
Yeah.
So over the last couple of years, we've virtually raised nothing,
Mm.
some debt, but very, very little, and we've had to cut our cloth, to what we can do. So there are things that we do, like reduction in fleets, etc., to to reduce kind of overheads, and then we switch it back on. We actually kind of play the game as such. But what I know is that the kind of the business model that we created in terms of financials and so on, it if we endure that into a bigger scale, which is what we're doing now, we can be super profitable, right? If we get it right, we can be super profitable.
On the failure of companies, I don't know if I would blame it fully on the investors. So I mean, of course, money was cheap at that time. It was a ZIP era, so there was enough cash. But if you look at the companies that are surviving today, one thing that's common among everyone is that they are very good operators, and second is that they had financial discipline, at least to an extent, right? Anybody that did not have these two, they suffered. Right. So, I don't know if I would blame entirely on the investors, but having said that, I really hope cash will come back to this industry. We already see signs of that happening. I mean, if you look at the recent raise that Dot did, there was an equity component as well, right? So, I'm hoping that cash will come back to this industry, given the fact that the potential is massive.
Yeah, I think it will probably, and it's kind of more mature cash. So what the Voice and the Dot tiers are doing at the moment, I mean, this is more mature cash, right? This is not speculative cash anymore. It is business disciplined cash and investment. It's not a game, if you know what I mean. And what I mean by investors, I mean, go back to kind of the 2019s, 2018s, where people were cutting checks for 200 to 300 million, right, on a punt, right, and they hadn't really proven out models at all, right. That's what I mean. Now, there's obviously, you're right. There's disciplines within the company, right. Where a company takes on this cash and suddenly their head office costs just balloon. There's something wrong there, right? And it's not going to work for them. But I think you're absolutely right. What we're in now is almost a mature market. Investment money is mature. The approach by the companies that are in the business is mature. A lot of the smaller companies, they also got fatigue, right? Which is, it just is a tough business, right? Because you're always chasing your tail in terms of cash and money and expensive assets and so on. And it's not for everyone, right? You say I have a lot of energy. Yeah. And you need that. That's what you need in this business, because if you don't, you will go on to something easier. And I have nothing against that. That's fine, right? But
we have a lot of founders that are no more. They're not building in this industry anymore. I mean, if you look at most of the top companies, Lime's founders, they're not with the company. Bird, no. I think Voy, we have just one founder left. So any company that you look at, founders have moved on, and I'm with you that you need an extra kind of grit and resilience for you to build in this industry. It's not for anybody. It's not something that you can build sitting in front of a computer or putting a prompt in an AI chatbot.
No, and look, that's, I mean, in our journey, we've acquired two small companies in the UK, and we can go into the details of why we did that, but the founders in those companies were tired, right? As in, they weren't getting to the economies of scale. Funding had really kind of dried up, and the only way to get that scale was to get investment, and the only way to get that investment was through the market, and the market didn't exist. So it just seemed, I suppose, useless and pointless to them. Right? So we have seen that and that's replicated. Those two companies, well, we acquired them, right? But there are another 22 that just closed the doors.
Yeah, I mean, I get a lot of founders reach out to me who were building in this industry and are still building. And one of the key reasons why they want to exit is because they are tired. They've been building for so long, and exactly the same reasons that you said. But I think that's a good segue into the next section, which is you did a couple of things very bold. So one is like racing less. Second is like trying to build your own hardware in, which is completely different from everyone else. And the third thing that you did was acquiring companies. You acquired two companies in Ireland, if I'm not wrong, Swings and Zip. So
Yeah,
full disclosure, I was part of Zip's board when the deal happened, and then very recently Superpedestrian, right? So can you unpack that? I mean, was it part of your initial strategy that let's wait and acquire competitors and then grow, or was it just serendipity?
Yeah, and I think these are all related, right? I mean, we haven't raised big cash, and if you don't raise big cash, what's your alternative, right? How do you get economies of scale? So we started the journey of acquisitions, looking at acquisitions in 2022. And our first acquisition was a company called Zwings in the UK. And Zwings, was a very small operator. They operated in I think about 4 or 5 different locations across the UK. They had, I think, it was Segway scooters, and they were at a stage where they were kind of generating, I don't know, probably £1 million a year, right? But that's not sufficient, to be profitable and so on.
Yeah.
So they had a choice of either closing the door or trying to sell the company or get it acquired. What we kind of benefited from those things was, that we get the additional fleet and the additional footprint, but more importantly, we don't get the cost structure, right? Because if you take the example of Wings or Zipper and so on, when we went into both of these, we're like a machine.
Yeah.
So, the first thing, I don't want 2 platforms. Get rid of one platform, right? Let's migrate the platforms. Let's get all the scooters onto one platform, right? And you can actually, when company A has a platform and it's costing them 200,000 a year, and we come in and acquire them, that 200,000 a year vanishes in a sense, right? Because we just basically absorb it onto our platform with no real incremental cost, right? So what we're taking on those companies really is we're taking on the revenue line, right, without the costs, right, which gives us economies of scale. Now, obviously, there's some elements of costs, but most of them are direct costs that you're taking on, right? So they come into the case anyway. So the idea was that we would get kind of incremental scaling through those acquisitions. The second one was Zip, which is an Irish company, but it predominantly operated in the UK as well. And with that, we took on a number of markets in the UK as well. We introduced our own 2-wheel scooter on top of the existing fleet that was there. We migrated everything onto the single platform. We, consolidated things like insurance, operation costs, whatever other platforms and so on. And what it did do is it enabled us to get that incremental revenue without the proportionate, central costs as such, right? So that kind of proved to us, that we could do that. Now, UK is another story. I mean, we're not operating scooters in the UK at the moment, for a completely different reason, right? And that's a gripe I have with the sector, micromobility sector, is the insurance, it has a risk of destroying the market. Right?
Yeah, can you explain that a bit more, because not many in the industry understand the insurance risk, right? Can you explain that a bit?
Yeah, I mean, look, it depends on the jurisdiction, and so you drive a car, and most countries it's mandatory to have what they call motor third party liability insurance, which is basically make sure that if you crash into somebody or something, that you have cover You're not leaving the other third party stranded. So in the same way, a lot of European countries have um, motor third party liability insurance for scooters. So at the start of this journey, obviously, insurance works on data and insurance claims and so on. In the early stages of the market, there's no claims, right?
Yeah.
There's no data. So premiums were, almost finger in the air kind of premiums. But over the last number of years, that's continued to rise, and the cost of insurance is disproportionate in terms of your direct costs. And this is going back to what I was saying about rides per day versus optimal. Insurance skews that, right? So if you've a lot of rides, you're paying a very, very big, hefty insurance premium. In the UK, what happened with us was that the insurance company that was operating there just decided not to operate anymore. And as a result, we were kind of forced into find an alternative which didn't exist, right? Which basically didn't exist. And obviously the bigger insurance companies wanted the bigger players, right? So therefore, they had minimum premium sizes, which just didn't make it commercially viable for us. So yeah, insurance is kind of an issue, I think, because every year since I've started this, we've seen increases in the cost of insurance. And insurance is, among other things, like it is abused. People think they can get 5,000, 10,000 from an insurance claim, they'll get it.
Why is it like a problem in the UK and not a problem in Germany, for example, or you have the same issue everywhere?
In terms of rising costs, or in terms of
in terms of rising costs, or in the UK, like you said, for smaller operators, that's clearly there's no player offering those insurances either, right?
Yeah, well, our experience in because the UK was almost a separate market, post Brexit and so on. The company was Zego, and Zego decided not to operate this market anymore from, I think it was July 1st, 2024. And we couldn't get an alternative in the UK market. There was only the big players, and the big players obviously wanted huge premiums, which wouldn't have made sense for a fleet our size. In Germany, we have obviously a bigger fleet, and we have got some good partners in Germany for the insurance. But it is still a big part of the costs of running the business. And what we'd like to see is that the premiums would I suppose start to plateau out in terms of now that they've built the understanding of the market and the risk profile and so on, that we would start seeing premiums plateau. And that, look, it is normal. I mean, it's the same with car insurance. It will eventually kind of settle, but obviously they have to manage claim cultures and so on.
Got it. I want to move on to the bigger story. In your entire the company history, which is acquiring Superpedestrian. So can you tell us about what went there? Because we all know Superpedestrian for a very long time. In 2019, I still remember that they actually came to the Micromobility Europe conference. They exhibited their scooter, which is a very advanced scooter. And at that time, they were trying to sell the scooters, right? Because it had name any advanced tech at that time except for computer vision. They had everything, all the predictive maintenance. The entire scooter was packed with sensors. So if something goes wrong, you would know it. They also built an amazing platform around it as well. So they were trying to sell the scooters, and what I understand is that they couldn't sell those scooters because I mean, if you look at the larger players, I don't think anybody bought those scooters. They went to Segway or Okai or other players and bought those scooters, right? So then,
Yeah.
eventually, they were sitting on a large pile of scooters and decided to launch their own sharing service under the brand Link, right? And they were operating for some time, and then they had to file for bankruptcy. And the guys from the Nordics, they picked that up for a couple of million, I believe. And here we are, where you have acquired everything. So, can you tell us what what's going on and what the deal is about? Tell us about the deal.
Yeah, so look, I mean, I suppose in early last year, 2025, and this is my life problem. Like, it's kind of, okay, where are we getting the next few shillings from in terms of growth?
That's what I was saying initially. Every time I meet you, you have something new.
I know. Right? So, the first kind of half of the year, we were kind of looking at a reasonably what I call an aggressive organic growth plan, which looked at investing in fleet, new markets, which required a significant chunk of capital, and more than what we had raised to date, if you know what I mean, right? So it was a new chapter, and really, it wasn't getting much traction in the market, in terms of the investors that we were talking to still considered that there was significant risks in the market, in the business. People cite things like Paris banning scooters and so on. So they felt that these were probably conservative investors, that the market hadn't proven itself out yet, and there was concern there with it, right? So kind of mid 2025, I decided to kind of shift the focus of our kind of growth strategy to pursue another acquisition, right? Which was what we had done in the past, but to a small scale. And the acquisitions, I mean, we looked at a couple of companies, right? But what we needed really was that we with an acquisition, that we get kind of more probability of kind of footprint. B, we would get obviously kind of assets that we don't have, and C, there would be the ability to get the economies of scale and get consolidation, right? So that they're kind of the important kind of factors to us. Now, it was the Superpedestrian was quite interesting, because back in the day when Superpedestrian was big, and look, they had a very wrong model, right? Like, they invested 100 million into their tech, right? They raised 300 million, right?
Okay, so I gave a small number then.
Yeah, no, it's 100 million into the tech, and there are various rounds. I think somewhere around the 300 million was the number I got from them. But this is micromobility. This is not rocket science. And spending 100 million on tech, and you're right, it's great tech. It's the scooters, great tech, and so on. But can that sustain? It's like buying the scooter for €5,000, the asset. It's going to take a long time for you to get those unit economics working for you, right? So it was just the wrong model that they kind of adopted. This is a very tight margin business. You have to be careful on the costs, and the cost of assets and everything else. And that wasn't the case. They were obviously more focused on the tech, and they thought this was a tech company. It's not a tech company. It's a micromobility company. So, I was always kind of looking at these, and actually it was one of the ones I predicted would go bankrupt, and they did. Which, sorry, by the way, like, it's not funny, going bankrupt, right? But it's I'm sure it's very painful and so on. But the writing was on the walls, for that. So the guys in Surf Beyond, yeah, they, at the time, by the way, that was the end of 2023. You know, it was a tough time in the market, right? So there wasn't very much interest from anyone else acquiring Superpedestrian Inc. in the US.
Yeah.
So the guys in Norway went for it. Um, and I suppose what they did was, they basically bought Superpedestrian Europe, which was
Mhm.
positioned in Holland, and they wanted to make a go of kind of relaunching the market and so on. Now, at the time, actually, I reached out to them. I spoke to them and said, "Look, we can work with you on this because
Mhm.
we kind of understand how difficult this market and the business is, and we can get benefit because we get a bit of growth from it, and you guys can get benefit because you can get
Yeah.
execution." Um, but they declined at the time, and that brought us back to the conversation in mid last year when the BV in Holland, which was the original Superpedestrian, went into bankruptcy again.
Oh wow.
Um,
Okay.
yeah, so now to be fair, like they took on a lot of legacy costs, a lot of legacy debt, which without the right structure of working capital or the right backers in terms of VC or
Mhm.
investment, it can be very hard to sustain that, particularly as you're trying to regrow the business.
Yeah.
Um, so that, I suppose, was the reason for the European BV in Holland to be declared bankrupt in
Mhm.
July of last year. Um, so, we've over the last kind of 6 months, we've been working with this to look at, could we bring this back to a viable business? And we've worked with the trustee in Holland with regards to the purchase of subsidiaries
Mhm.
of the BV, or not the BV itself. BV itself went into bankruptcy, so we purchased a number of the subsidiaries, and we also independently purchased a number of the assets,
Okay.
and then we purchased, excuse me, we purchased the effectively the last couple of subsidiaries and the technology directly from Surf Beyond then.
Mhm.
So that deal was done on the 27th of February. It brings in a um, pretty good fleet, right, of
Mhm.
about 17, 18,000 scooters.
Mhm.
Brings in a very interesting platform, right? I'm
Yeah.
dying. I'm dying to see what they spend 100 million on.
Yeah.
But but I know what it can do, and it is
Mhm.
very advanced, right? And the scooters are very advanced, right? I
Yeah.
mean, the batteries in the scooter have like real phenomenal BMS
Mhm.
system that is nothing like anyone else is using.
Mhm.
And it's like that there's some real good advantages of it, right? It's not going to mean that the customer is going to pay more for
Yeah.
a ride in the scooter, right? But what we've just bought, really, or what we've acquired, is that's all legacy investment that's
Yeah.
gone, right? So we're getting
Mhm.
the benefit of the good scooter and the good platform and the extent of 17, 18,000 assets without taking on the actual what they invested in it in the first place.
Yeah.
Right? So the whole idea, Robin, is we want to get the economies of scale based on our own
Mhm.
financial model so that over the next 12 to 18 months we can see that we're generating good unit economics on rides per
Mhm.
day and financial productivity model, but a lot more is being absorbed in the overheads, and
Yeah.
therefore we're going from EBITDA to EBIT,
Mhm.
net profitability,
Mhm.
and then out, right? And then out.
But in terms of business, the acquisition, does it like double your business, triple your business? What's in
Quadruple,
terms? Oh
quadruple,
wow, wow.
yeah,
Okay, okay,
yeah,
okay, okay.
quadruples our business.
Nice.
Once we get it done, right?
Yeah,
We have to bear in mind, Superpedestrian does not operate at the moment,
yeah.
and therefore the scooters are in 1,000 different warehouses everywhere, right? So, we have to get it up and running, which we've, me, like we've got a lot of energy and focus and so on. We are just ready to go type of thing. And, I'm sure there'll be mistakes. I'm sure there'll be hiccups. I'm sure there'll be issues, right? It hasn't been, the last 6 years hasn't been issue free or hiccup free, right? So, I know what to expect, and I'm a little bit more calmer in those expectations than I used to be. So look, I think it's going to be a big challenge, but it's going to be, a very interesting ride over the next 12 to 18 months to take them on, right? And yeah, what we've done is ballsy, right? Because that it was either that or you go backwards, right?
Yeah.
That's not an option for me.
Yeah. And so in terms of business, probably, it's going to 4x your revenues. In terms of market, is it still going to be concentrated to Germany, or is it going to open up a couple of new markets for you?
Yeah, no, it'll open up some new markets. We haven't absolutely finalized the markets that we're going to enter, because there is a bit of work for us to do to kind of understand, because it's like we shouldn't be looking at kind of footprint at all costs.
Yeah.
Right. So we need to be careful on where we select. I mean, in our early days, we had small fleets in Sweden, we had small fleets in Norway, we had small fleets in Italy, Croatia, Malaysia, right? And that creates 5 times the work, right? But also it's logistically it's difficult as well, right? So we are going to be probably more concentrated in where we operate, but it will be Germany plus other markets.
Got it. You're one of the very few founders that I know with so much energy. Right from the time I met you, and even today, I mean, you're super super high in energy. There are many founders out there who are tired, or many founders out there who want to build in the space. What's your message to founders who would listen to this podcast?
Well, look, I think it's natural for founders to get tired, right? There's tired, and then there's burnout. I think when there's an opportunity. I mean, for me, for example, if I don't see that opportunity, that tiredness could result in burnout. Whereas, I think that the reason why I have a lot of energy is because I have a lot of ideas, I have a lot of kind of focus and so on. And that's not everyone, right? So, but what I would say is, if there is a kind of a North Star there that you're pursuing, don't get up on it, right? It'll be tiring to get there. It's like climbing up a hill, right? You're not going to do that and not get tired, right? But when you get there, you'll be happy that you did it, right? And I suppose my advice is, if you're getting tired beyond, heading for burnout, stop, right? And take a rest and do something else. But if you've got the energy and you've got that kind of North Star, that will automatically give you that boost and that energy to reach for. So
absolutely. Yeah, I mean, for founders who are listening to this podcast, and if they're going through a tough time, I think they have to talk to you.
Yeah.
Perfect. But massive congrats on the acquisition. It's a major step for you and the company. And thank you so much for joining the pod and sharing everything that you shared. So
you're very welcome.
Pleasure talking to you.
Delighted to do it. Yeah, great. We'll see you in Berlin.